Hey everyone, this is the video that will continue the trading and the stock market and tax video. Uh, so where I left off was you're basically going to be adding anything that you earn from trading stocks into your income for that year to your tax documents. And that may or may not change which tax bracket you're in, which would make it so that you're paying more money for taxes up to a certain amount. But that's not always the case. Say we have our company X that we're investing in, and we did buy that 10,000 shares at $1. So that's $10,000 of our money in that we have. We have those 10,000 shares now. If it were to go down, say it went down 12%, then we would have only 88 cents value per share that we have. So and the market can go up and down, like no matter what. I mean, at any time it just fluctuates constantly. Just open up Google Finance or Yahoo Finance, check any stock, and watch it throughout the day that it's open. It's just most of them just go up and down unless they're having a really good day. Then they're going to go straight up. But we've got our 88 cent per share stock now at Company X. So the value of our money is the value of the amount of stocks that we have in that company. It's no longer $10,000. It's considered $8,800 now, because each of our 10,000 shares are only worth 88 cents. And if we had an emergency or something, or saw another opportunity to invest that money, we would want to sell that and take that $1,200 loss so that we could use those funds for something else, like an emergency, or, like I said, to invest in something else, or you just need the money. Besides that, you don't need to ever sell that stock. If the company that you're trading, the publicly traded company, goes bankrupt, then the stock price will go to zero, and you will lose all of your money that you had invested. The price of each of your 10,000 shares will be valued at zero, and they will never rise again. That's it for that. Which is why something that people call penny stocks are pretty dangerous. Penny stocks are stocks that have just the company's not done very well, or this is how I understand it. The company hasn't done very well, and the price decreases so low that it becomes in the pennies, like less than 10 cents. So obviously, if you're at 10 cents a share and you buy a bunch of shares and it goes up 1 penny, that's 10% increase already. So if you go up 10 cents, which for some other companies, which have hundreds of dollars per share, 10 cents is nothing. But 10 cents for a 10 cent a share company is 100% increase. You could easily double your money playing around with penny stocks. But that's also dangerous because it can also go to zero. But before it goes to zero, if you'd like to sell, you can, and you lose that money. But the good news is, in your taxes, you can claim up to $3,000 loss to be removed from your taxable income at the end of the year on your tax documents. They cap it at $3,000, but no matter how much you make in the stock market, all of that will be considered income for tax purposes at the end of the year. So basically, that's how the stock market works. It goes up, it goes down. You don't ever have to sell. But you basically want to buy low and sell high. You should just watch. There's so much to learn about the stock market, and I think it's very complicated the way they come up with all these numbers, because it's just the constant fluctuations. and how it depends on individual people. You can't really predict what people will do because there's just so many factors. That's basically how that works. If you guys have any questions, I'm sure that I can look it up or just give you the answer that I think would best fit your question. Like I said, I only know the basics, and I trade here and there. If you trade often, like I do, that's called day trading. But when you're trading with a company like that and you're not dealing with too much money, the funds in your account need to settle before you can use them. So say I purchase the 10,000 shares of company X, and it goes up 12 cents, like in the example I used yesterday, and I decide that I want to sell that and claim my $1,200. So I sell all 10,000 of my shares. You don't need to sell all 10,000. You can sell less than 10,000 shares if you want to claim only a little bit of your money back. Or you could buy more shares of that same company at a different price, and that would end up either helping you or hurting you depending on where the money was. But that's probably another video that I would have to do because there's just so much information. But I'll try and keep it basic. If you guys have more questions about it, you can ask. What I just did there was I sold my 10,000 shares, and now I have in my account that I used to have $10,000, I have $11,200. When that hits my account, it's not actually my money until the funds settle. It's what they call it, which takes 3 days. So if you're trying to be a day trader and trade every day and throw in money and then wait for it to go up a little bit, sell it right away, you can't really do that unless you have multiple sets of cash that you'd like to use. If you put all your eggs in one basket, which is never really a good idea because you can never be 100% certain, you run the risk of not being able to trade daily and missing out on things if you are using predictors or calculators or methods for predicting whether or not the market will go up or down. So basically you're limited to your funds settling, which is another thing. There's just so much that I could talk about. I think I might just end it here. I'm really tired. Had a pretty long day. And then tomorrow at work, we're celebrating birthdays for the month of January. And my birthday's in January, so I'm one of the people that's being celebrated. So we all bring in food and stuff. I went to Jewel and I got some chips and salsa. So I'm going to bring that in. People usually bring donuts. So that's going to be really exciting. But anyway, that's tomorrow. If you guys have any questions, I think I might do another video concerning either taxes or trading stocks, because there is a lot more information. Like shorting is when you it's kind of hard to explain because I've never personally shorted. A coworker of mine that actually got me into trading has shorted, but it's basically reserving the right to buy a share at a certain price, and that works the best when the stock goes down. So you can bet against a company. Say you're like, let's use the example that I've been using, company X. Say you're investing in company X, but you think that they're going to go down. So you short that company 10,000 shares. Say they drop 50 cents for the easiness of this example, and now they're at 50 cents a share. You have the right to buy however many stocks that you reserved at that price, 50 cents, but sell it at $1. So really you made 100% when they lost 50%. I hope that gives you guys some basics. I'm sure if you're trying to get into this and you're looking up videos for trading, that you have a lot more questions. I'd be happy to help you. I'm here to help you guys with anything. I'm not going to just talk about stocks and taxes in all my videos. I want to change it up and share all my knowledge. But that's just one of my interests, and it's one of the things that I like to do. So there you have it. Have a good night, guys.